morning, good evening, wherever you may be watching this video. Today, we're kicking off a mini series dedicated to yield trading. The most common way of participating in a market is to trade an asset based on its price. But there is another market that doesn't have to do with trading an asset based on its price, but on the yield in which that asset can generate. This is what's called yield trading. And honestly, it took me a while to understand what yield trading actually was, but once I understood it, it made DeFi click on a different level for me, and I expect it to do the same for you. So, with that being said, let's get right into what yield trading is and how we can utilize it to our advantage. For starters, what exactly is yield? If you've ever participated in an LP by providing liquidity, or you've earned interest through lending out your assets, or you staked any type of crypto token, you have earned a yield through those activities. Yield trading takes this just a step further. Instead of just earning yield, you can separate the yield generated from the asset, you can put a price on it, and you can trade. Yield is the return that you earn by putting your assets to work, by either participating in an LP, lending out your assets, and earning interest, or staking rewards. Normally, by holding a yield bearing asset, you are exposed to two different things at the same time, and that is the asset's price and the yield that it can generate. Let's say you're earning 30% APY, which is actually pretty solid, until the price of the asset you're earning that 30% on drops by 40%. And that is where the issue lies within traditional DeFi. It's variable, unpredictable, and it's directly tied to the price of the asset in which you're earning that yield on. As we should know by now, high yield does not always mean high returns. Yield trading enables us to separate the future yield from the asset itself. Once separated, that yield can be sold up front, locked in, or traded independently. Instead of trading price, you're trading future income. So price risk and income risk become two separate markets. For a simple analogy, think of a rental property. You could own the house and collect the rent, which we'll call the PT or principal token. We'll get into what exactly that is in a later video. You could sell the future rent payments, which the rent in this case is the yield. So that will be the YT or yield token. Again, we'll get into that in another video. Or you could buy rent from someone else's property, which is essentially just trading the YT or the yield token. Yield trading does all of this on chain. The asset stays the same, but the income stream becomes tradable. Yield trading brings something new to crypto that we really haven't had until now, and it definitely makes players that have been outside of traditional DeFi a bit more comfortable with deploying capital and earning yield on their assets. Yield trading brings fixed yield, predictable returns, and much better risk management. Yield trading can work in bull markets, bear markets, and sideways movement. Yield stops being passive and becomes a much more strategic aspect of putting your assets to work. This is really the foundation of yield trading. In the next video, I'll be covering how yield is actually split into different tokens, starting with what a principal token is, or PT, and then we'll dive into what a yield token or YT is. So be sure to like, share, and subscribe, and I'll catch you in the next one. Peace.